Warren Buffett, the greatest investor alive, says ordinary people should buy one specific thing with their money, not Tesla, not Apple, not Bitcoin, a boring product called an ETF. And most people have never bought one. Here is what it is. An ETF is a basket of hundreds of companies bundled into one product. When you buy one share of an S&P 500 ETF, you instantly own a tiny piece of Apple, Microsoft, Google, Amazon, Nvidia, and 495 other companies. One purchase, hundreds of companies. Instant diversification. Here is why experts say you need this. Picking individual stocks is gambling. You bet on one company. If they have a scandal, if they lose a customer, if they get disrupted, you lose. But with an ETF, one company can collapse, and you barely notice, because you own 499 others. Now here's the part most people do not know. In 2007, Warren Buffett made a famous bet. He bet $1 million that a simple ETF tracking the S&P 500 would beat a basket of professionally managed hedge funds. Over 10 years, the hedge funds were run by some of the smartest people in finance, earning millions in fees, trying as hard as they could. The S&P 500 ETF returned 125%. The hedge funds, run by the best in the world, returned 36%. Buffett won by a landslide. And here is the kicker. The ETF cost almost nothing in fees, less than 0.1% per year. The hedge funds charged 2%, plus 20% of any profits they made. The smartest move in investing was to stop trying to be smart and just buy the index. Most people in their 20s who started buying one ETF a month are now richer than people who spent years picking individual stocks. It is boring. It is unsexy. It works. Follow, because the most important investment lesson is also the simplest.